So, our group decided to talk about the GDP of the United States over the past 10 years and the additional debt of the country. United States has the world's largest national economy. Its nominal GDP was estimated to be almost 14.7 trillion in 2010, approximately one-fourth of the nominal global GDP. USA's GDP purchasing power parity was also the largest in the world, approximately one-fifth of the global GDP at purchasing power parity. The United States maintains also a high level of output per capita. In 2009, the country was estimated to have almost $47,000 a per capita GDP, which is the sixth highest in the world. The success of the economy comes from the fact that the United States is the largest trading nation in the world. Most economists believe that the U.S. economy has maintained a stable overall GDP growth rate, a low unemployment rate because of a high capital investment funded by national and foreign investors. Let's talk about the GDP of the United States over the past 10 years a little bit more. In 2000, the United States was the country with the best GDP in the whole world, which was $9.7 trillion, followed by Japan with $4.6 trillion. In 2001, the United States was still at the top with $10.07 trillion, again followed by Japan. In 2002, the United States maintained a GDP of $10.4 trillion. In 2003, of $10.9 trillion. In 2004, of a GDP of $11.6 trillion. In 2005, the United States maintained a GDP of $12.4 trillion. In 2006, the United maintained a GDP of $13.2 trillion. In 2007, of $13.8 trillion. In 2008, of $14.3 trillion. In 2009, of $14.5 trillion. And in 2010, of $14.7 trillion. As you can see on the graph, the GDP of the United States over the past 10 years has been growing very smoothly. We did not put the GDP for 2011 because it has not been fully calculated yet. As you can see, the GDP kept growing from 2000 to 2010, and it looks like it will keep growing even in 2011. This sounds incredible, taking into account the huge finance crisis that happened in 2007.
The subprime mortgage crisis has put the U.S. economy into the worst recession since 1982. The primary explained the financial tools that allowed loaners to subprime borrowers without taking responsibility for the risks of the future default. As mortgage interest rates risen and borrowers default, these tools spread the risk into every corner of the globe. This creates a widespread crisis that shows no signs of ending. Subprime borrowers are those who have poor credit histories and therefore more likely to default. Loaners usually charge higher interest rates to prevent more return for the greater risk. Normally, this makes it too expensive for more subprime borrowers to even make monthly payments. Interest-only loans helps to lower monthly payments so subprime borrowers could pay them. However, because the internal rate usually resets after 1, 3, or 5 years, the rising housing market of the last few years confirms loaners who announced that borrowers could resell the house at a higher price rather than default. Mortgage-backed securities allow loaners to bundle loans into a package and resell them. In the days of conventional loans, this allowed banks to have more funds to loan. With the advent of interest-only loans, this also transformed the risk of the loaner defaulting when interest rates reset. However, as long as the housing market continued to rise, the risk was small. In fact, the advance of interest-only loans combined with mortgage-backed security added so many liquidity in the market that it created a housing boom. Every boom has its bust, and by 2006, the housing market started to decline. When subprime borrowers could now sell their house at a higher price, they were forced to default. Since the loans has repackaged and sold, they could even negotiate a statement with their bank. However, the Rex was not just confirmed the mortgages. All kinds of debt was repackaged and resold as collateralized debt obligations (CDOs). As housing price declined, many house owners who had been used their houses as ATM machines find they could no longer support their lifestyle. The firms on all kinds of debts started to slowly creep up. Holders of CDOs include not only lenders, but also corporations, pension firms, and mutual funds, and the individual investors who owns them. The real problems was CDOs was there were so complicated and so new that the buyer do not know how to price them. The stock market was booming. Everyone was under so much pressure to make money that they often bought their products based on nothing more than word of mouth. Most of the purchasers of CDOs were banks. As the firms started to mount, banks were unable to sell their CDOs and so had less more money to lend. Those there who had funds did not want to lend to banks that made the firm. By the end of 2007, the Fed had to step in as a lender of last resort. The crisis has come fully circle. Instead of loaning too freely, banks loaned too little, which caused the housing market to decline further.
During the financial crisis, the United States government tried to help the economic recovery by cutting the tax and increasing the spending, but it largely boosted the debt level. Since the government didn't have enough money due to the tax cut, they need to put a large amount of money on the spending by involve many programs. The government have to create a new debt for the war spending and recovery program. Some economics consider if the debt level is over 19% of the GDP, it will be danger to a nation's economic. On May 16, 2011, the total debt of the United States reached $14.32 trillion and was approximately 98% of the 2010 GDP. It means the United States have owned the money which almost equal to the value of the goods it generates during the whole 2010. The dramatic increase probably mainly caused by the Iraq War in 2008. Bush administration projected the cost of war will be around 50 billion. The Pentagon estimated the spending during the Iraq War is at $600 billion. The Nobel winner economics projects the long-term cost of the Iraq War is more than $4 trillion. It will add a huge amount on the national debt. The result of the war, which is completely funded by borrowing the United States debt, soared from 6.4 trillion in March 2003 to the 10 trillion in 2008. In the progress of the United States history, the war would be a huge reason caused a major increase at the debt. During the Civil War, the debt surged from $65 million in 1860s to the 2.7 billion. After World War I, the debt reached to 25.5 billion.
Another reason for the US owning a lot of debt is that the US spent too much on healthcare. More money per person is spent on healthcare in the US than in any other nation in the world. A 2001 study in 5 states found that medical debt contributed to 46.2% of all personal bankruptcies. In 2007, 62.1% of filters for bankruptcies claimed high medical expenses. These results the United States to borrow money from other countries. Now the total debt of the US is about 40 trillion. The largest debt owners are China and Japan. This chart below shows the details. According to China's new status, it now owns nearly $1 out of every $10 in US public debt. Overall, analysts say China's holdings are about 800 billion or more. On the other hand, Japan owns 573.2 billion. So the big question is why these countries are willing to lend money to the United States. First of all, China and Japan plan for the long term for their economics. They believe it is better to be a creditor than a debitor. Second, America's currency is admitted by every nation in the world. To avoid bankruptcy, America just needs to continually enhance the security of its currency and literally print US dollar bills. This also means that by holding the debts of the United States, these countries actually make money because the currency and the interest rate of the US dollar bills is high.
As a conclusion, we can say that the national debt and the GDP of the United States over the past 10 years are very closely related because, as we can see, in the years when GDP was higher, the national debt was lower, and vice versa. The United States, however, are still trying to pay their national debt off to countries like China and Japan.